Hello and welcome to this video. In this video, we're going through case study 11, question 1, North Campus Freight Services Ltd. So what I'm going to do in this way, I'm going to read through the scenario and point out the important issues. In the next video, I will be working through answering the required. So let's get going. So they say North Campus Freight Services Ltd, NCFS, is a leader in, I just scroll down, is a leader in the South African shipping and logistics industry. The company transports goods to all parts of the world. NCFS owns a warehouse in Johannesburg that facilitates the storage of its shipping containers. NCFS transports customers' goods in NCFS containers by road, air, or sea. NCFS was founded back in August 1980 by Frederick Johnson and has grown from a small shipping company into a major freight and logistics business in South Africa. Okay, so just take note, they own a warehouse and then they transport customers' things via containers. Okay, so they say the financial accountant of NCFS was dismissed during December 2014 due to misconduct. While the financial director of NCFS was preparing the financial statements, she realized that some of the financial reports were not yet prepared by the financial accountant and were incomplete. You were requested to assist in finalizing the financial statements of NCFS for the year ended 31 December 2014. Okay, so here we can see we are busy with the year in 31 December 2014. So that means the beginning of the year is 1 January 2014. So we're busy with the financial period 1 Jan to 31 December 2014. The following matters for the year ended 31 December 2014 must still be accounted for. So property. NCFS owns a warehouse and an office building. The warehouse facilitates the storage of the shipping containers of NCFS and also provides office space to NCFS employees. On acquisition date of the warehouse, the useful life was estimated as 22 years and the residual value deemed negligible. The estimated residual value and the useful life remained unchanged from the acquisition date. The warehouse qualifies for a tax allowance of 5% per annum, not apportioned for part of a year, on the cost of the warehouse in terms of Section 13 Quin of the Income Tax Act. The office building was used as the head office of NCFS from acquisition date of the building until 31 March 2014. On acquisition date of the building, the useful life was estimated as 25 years and the residual value deemed negligible. Due to the demand for property in the area, NCFS decided to lease its office building to another company. The operating lease agreement with the company commenced on 1 April 2014. The fair value of the office building on 1 April 2014 is 5.2 million. On 31 March 2014, the employees of NCFS moved from the office building to the warehouse, where additional office space were made available. The building has never been impaired in terms of IAS 36 impairment of assets. The estimated residual value and the useful life remained unchanged from acquisition date. The office building does not qualify for any tax allowances. Okay, so what happened over here? So we have property, we have two properties, a warehouse and an office building. So both office building and warehouse, because it's owner occupied, will be classified as property, plant and equipment. However, on 31 March or on 1 April 2014, there was a change in intention. The office building was no longer used as an office building, but rather rented out to a third party. Since it is rented out to a third party, it no longer can be classified as PPE. It will now be classified as investment property. Why? Because it is moving from owner-occupied to a property where we're earning rental income. So that now becomes investment property. So on 1 April 2014, there will be a change in intention and a reclassification from PPE to investment property. Okay, so we have warehouse and office building acquisition date, total cost, fair value on the respective dates 31 December 2013, 31 December 2014, and a tax base on 31 December 2013. The warehouse and office building are measured in accordance with the cost model of IAS 16, property, plant, and equipment. Depreciation for the year on the warehouse and office building is provided for on the straight line method over the assets remaining useful life. Investment property is measured in accordance with the fair value model of IAS 40, investment property. Okay, so there will be an implication at the date of change. Now we have shipping containers. NCFS is expanding its services to the rest of Africa. This led to an increase in demand for shipping services, and consequently, NCFS requires more shipping containers for the storage and transport of customers' goods. NCFS decided to purchase new shipping containers from a supplier in England. On the 30th June 2014, NCFS placed a non-cancelable order for 80 shipping containers from its supplier in England for a total amount of £320,000. Due to NCFS exposure to foreign exchange rate risk on this order, NCFS entered into a 5-month forward exchange contract at a forward rate of £1 equals 17 Rand 10 for the full amount payable. NCFS entered into the FEC on the same date the order was placed. NCFS obtained control of the shipping containers on 31 August 2014. On this date, NCFS paid $8,000 to a freight company in England for shipping the containers. The shipping containers arrived in Cape Town Harbour on 31 October 2014. The purchase price was settled with the supplier in England on 30th November 2014. The shipping containers were ready for use as intended by management on 1 December 2014. And so there's some important aspects over there. It is basically dealing with the exchange rate, dealing with the FEC contract, dealing with when do we recognize, at what date does the shipping containers come onto our books and at what amount, and then also knowing when to start depreciating. So remember, we only start depreciating when the item is ready for use. And so here we have the different exchange rates. The accounting policy of NCFS is not to do hedge accounting. The South African Reserves accept the accounting treatment of remeasurement gains or losses on FECs and foreign creditors for tax purposes. The shipping containers are accounted for in accordance with the cost model of IAS 16. Depreciation on the shipping containers provided for on the straight line method over the shipping container's useful life of 12 years. The residual value is negligible. The shipping containers included in the financial records of NCFS on 1 January 2014 were all purchased on 1 March 2005 at a total cost of 6,745,000 Rand. The SARS allows a write-off period of 10 years on the containers in terms of Interpretation Note 47, not a portion for part of the year. Assume that the SARS accepts the total cost of the shipping containers as recognized in the financial records of NCFS as the value on which the tax allowance is based. Okay. Investment in shares. NCFS owns an extensive investment portfolio in equity instruments that is managed by a reputable asset management company. The purpose of this investment portfolio is to achieve long-term capital growth on the portfolio. The total fair value gain on the investment portfolio held by NCFS amounted to 180,000 Rand for the year ended 31 December 2014. NCFS acquired this investment portfolio on 15 July 2014 at a cost of 5.8 million Rand. NCFS accounting policy is to present subsequent changes in the fair value of investments in other comprehensive income. During 2014, NCFS received dividends of 290,000 Rand on its investment portfolio in equity instruments. Okay, so let's have a look. We will go through that, thinking through that. Okay, so I have investment in debentures. On 1 January 2013, NCFS acquired 400,000 debentures issued by New Gold Ltd, a public company in South Africa. New Gold Ltd debentures are securities backed by gold bullion and are listed on the Johannesburg Stock Exchange. The investment in debentures is held by NCFS within a business model of which the objective is to collect contractual cash flows, and when an opportunity arises, it will sell the bonds to reinvest the cash in other investments with higher returns. In other words, both collecting contractual cash flows and selling the debentures are integral to achieving the business model's objective. NCFS acquired the 400,000 debentures at its total fair value of 5.7 million on 1 January 2014. A coupon rate of 6% per annum is payable in arrears on 30th June and 31 December. The debentures mature on 31 December 2015 at a face value of 6 million. On 1 January 2013, the market-related interest rate for similar bonds was 7.758, 7.578% per annum. The fair value of the investment in debentures amounted to 5.8 million and 5.9 million respectively. Okay, we will go through the details on all of this. What's important to take note, it is the objective. So as we go through this, I will explain it. Okay, so I'm not going to explain it now. When I do the question, I will explain it. So management estimated the 12-month allowance for expected credit losses on initial recognition of the debenture at an amount of 320. There was no significant increase in the credit risk of the debentures since initial recognition, and therefore management estimated the 12-month allowance expected loss of the debentures at 85,000 and 100,000 on 31 December 2013 and 31 December 2014. Okay, assume that the SARS accepts the amortized cost of the debentures as the tax base of the debentures. The SARS does not allow expected credit losses on the listed debentures as a deduction for tax purposes. NCFS received a tax directive from SARS indicating that any future taxable profits on the debenture will be taxed at 28%. Okay, so NCFS insurance. NCFS obtained an insurance contract for the transport of its customers' goods on 1 May 2013. The insurance premium is payable annually in advance to the insurer. The insurance contract renews on 1 May annually. The premium paid on 1 May 2014 amounted to 675. This amount has not yet been accounted for in the financial statements for the year ended 31 December 2014. On further inspection of the financial records, you also noted that the total insurance premium of 630 paid on 1 May 2013 was included in other expenses in the statement of profit or loss and other comprehensive income for the year ended 31 December 2013. SARS allows the total insurance premium paid as a deduction in the year it is paid in terms of Section 23H. Since SARS allowed the total 2013 insurance premium of 630 as a deduction to the 2013 year, it is not necessary for the tax period to be reopened. Okay, assess loss. A new entrant into the logistics market during 2013 negatively affected the profits of NCF for the year ended 31 December. On 31 December, NCFS had an accumulated tax loss of 780,000 Rand, and at that date, indications were that the company would not make taxable profits in the foreseeable future. NCFS, however, adjusted its business strategy during 2014 and was unable to obtain a number of new clients. This improved its prospects to such an extent that NCFS made a profit for the financial year ended 31 December 2014. Okay. Okay, so there we can see we made a profit of 21.5 million. Okay, additional information, the directors decided to early adopt, okay, the normal income tax rate, okay. The only temporary difference are those that are apparent from the information provided. All amounts are material. Okay, so I'm just reading that scenario. So we have an idea. I'm going to go read the required now, and then in the next video we will work through the required. So question 1, prepare the journal entries to account for all matters relating to the shipping containers in matter 2 in the financial statements of North Freight Services for the year ended 31 December 2014. Okay, so in matter 2, we must account for everything relating to the shipping containers. Number B, prepare the journal entries to be processed on 1 January 2014 to correct the error in matter 5, including the deferred tax implications thereof in the accounting records of North Campus Freight Services Ltd for the year ended 31 December 2014. Okay, so this is the correction of the error where they recognized the insurance premium of the 2013 year in full. Number C, this is a common question. Calculate the profit before tax figure after taking into account matters 1 to 5, as it should appear in the statement of profit or loss and other comprehensive income of North Freight Services for the year ended 31 December 2014. Take note, we only want the profit before tax. So we don't want any tax implications, and nor do we want any other comprehensive income implications. Okay, number D, prepare an extract of other comprehensive income of North Freight Services for the year ended 31 December 2014. You must present items of other comprehensive income in accordance with according to IS 19. According to IS 191B, items are presented before the related tax effects with one amount for the total amount of income tax. Okay, so there we have that. Then they say disclose the income tax note. Okay, so we will deal with that. Okay, so in the next video, we will be going through all of this. Okay.